Welcome everyone to Airing's Data Matters webinar. I'm your host, Priyanka Jain. And today we are diving deep into a theme that resonates with the heartbeat of every growth stage startup or growth stage company. And we're going to talk about navigating funding and cash flow, especially as we navigate these really crazy times. At Airing, we believe in the power of data to drive success and innovation. Airing has driven over 650 million in revenue by turning data into insights and actions and dollars using our data science, analytics, and engineering expertise. Our client list includes startups like Life 360, Inside Real Estate, Next Trucking, FCTI, and much more on the enterprise side, including Comcast, Air Products, James Smuckers, and more. My own journey started from academia. I have two masters, and both of my theses involve applied statistics and mathematics. I spent 2 decades immersed in the data universe, first at companies like Adobe and PayPal, and then later at Airing startup and enterprise clients. I have witnessed firsthand the transformative power of informed decision making, and my goal is to equip startups with the tools to thrive and scale. We have an amazing panel with remarkable minds for you all today. Let me introduce them to you, starting with Erwin Feldhaus. He's the senior advisor at Growth Capital. He truly embodies the spirit of innovation. With an MBA from INSEAD and diverse industry experience, Erwin's strategies have consistently propelled companies beyond the ordinary into the realms of extraordinary growth and success. Welcome, Erwin. Would you like to add something?
No, that's perfect. Thank you.
So amazing to have you. Next, I'm privileged to introduce Andrew Peterson. He's the driving force behind Aviso Ventures. Andrew stands tall in the realm of information security, not just as an investor, founder, and CEO, but as a true architect of high-performance teams. His journey from the foundational days at Signal Sciences to impactful roles at industry behemoths like Etsy and Google is a testament to his relentless drive and innovative spirit. Welcome, Andrew. So great to have you. Would you like to add something for our audience?
Very flattering. I'm excited to be here. Yeah.
Thank you. Last, but by no means least, is Nellie Vail, the strategic architect behind Spreedly's financial prowess. With a 15-year tapestry rich in strategic financial planning and execution, Nellie's acumen in transforming fiscal challenges into opportunities is unparalleled. Her leadership is a testament to the power of vision coupled with action. She's also one of my favorite clients. I got to work side by side with her and her team on some really cool projects at Spreedly. Welcome, Nellie. Would you like to add something for audience?
No, thanks for having me.
Great. All right. Now that we have that out of the order, let's talk briefly, or let's start with what's going on in the market. Like what each of you, how do you see what's going on in the market right now, and why is fundraising hard right now?
Valuations on private companies have gotten really changed. Let's call it the last 3 years, and so growth stage companies have certainly been affected a lot by that, and the founders' mentality around this has historically kind of been like, well, nothing's changed about a company, so why should the value be so much different? Well, yeah, you don't play in the public markets, so you don't necessarily have to see that stuff every day, or you don't really feel it viscerally. But the reality is, it really has changed. And so I think like the private markets are potentially one of the more challenging ones to be navigating right now, because you don't get that constant feedback like you do on the public markets in terms of what the valuation of your company is. And so there's some cognitive dissonance maybe between like what the founders think that the company's worth and what it actually is worth. And so those changes in valuation between the investor world and what the founders and or the companies that are running these companies think has created some let's call it friction, I think, over the last couple of years. And that's been changing, I think, more recently as the founders have kind of come to grips with the new reality of what these things look like. And over the course of, let's call it, the last 3 years, then people have really figured out that they need to change how they're approaching the future growth of their business, where it may not be as dependent on venture investing and or what almost acts as like a subsidy for their business to continue to operate in a way that may not be profitable or normal that other companies might look at, and really have to rely more on revenue as a means to being able to drive growth for them in the future. And that's changed then how they've spent. So we've seen, I think, really dramatic changes in terms of that landscape. I think we're still going to see some changes go forward, but that's kind of my perspective right now, is that the driving force on the growth of companies now. And by the way, this is growth companies. I also give this advice to really early stage seed and pre-seed companies, is they should be thinking about getting to revenue as soon as possible and using that revenue to fund their growth as much as they can, rather than relying on venture capital or other sources of capital, private equity, to be able to help them grow.
That's your advice just for the moment, at the present moment right now? Because I mean, the whole point of VC funding is that subsidization, and that, that I don't need to get profitable for a while because I have that trust. So is that your going forward advice, or is just for this moment in time that we are at?
I mean, I think you always have to take the context of where funding is at to understand what your strategy should be from a business perspective. But I would say 3 years ago, and I've had this conversation with other founders, they would bring up the concept of, hey, this is where we're at from a profitability perspective. And they would get scolded by their investors to say, that's not the point of running a business right now. The point is to grow as fast as humanly possible. And if they could get access to capital and large amounts of capital, and they could grow like that, that's okay, at least to some extent for some amount of time. But I mean, even when companies went public, most of these companies don't have a PE ratio because they don't have earnings, because they're not profitable yet, right? So I think it's just been a very long time that especially tech companies in some ways have been able to get away with having a non-profitable business model for the sake of growth.
That's changed from here on forward. That's not about, you don't see that changing. What they were able to get away 5-10 years ago, they're not going to be, because the funding is going to be tight, most likely. Interest rates are where they're at. Inflation is where it is at. Even with correction, we still have to be more diligent than before.
Yeah, I'd like to agree with you, but you throw a little AI into somebody's business model, and that all those rules go back out the window, apparently, and then you could just grow on VC dollars again. So it's the context around the different types of businesses, I do think matter a lot here.
Got it. Erwin, you were going to say something and I interrupted.
Well, I guess your initial question was, what is going on right now? Nothing is going on that hasn't happened already multiple times. So when the internet bubble burst in the year 2000, 2001, we experienced exactly the same. So the appetite for investors to put money into venture diminishes for some time, and puts a lot of pressure on the businesses themselves. And yes, so there's many venture capitalists that like to push the companies to grow fast, because that's a way to quickly exit and multiply their money. But actually, if the company is there, if they're trying to really build a business, at the end of the day, what they need to have is customers that pay. And the quicker they can get to that scenario, when they have customers, and even if they can get to profitability quickly, that makes them much stronger, right? Is not necessarily the fast and furious growth that you could have if you just throwing money at the problem. But at some point you get caught up by reality, right? And so I guess what Andrew was saying is that's the advice that a company should always get, is you should have something that people want to buy, that people want to pay for, and you should find that product or service as fast as you can. And then if you get that, then it's fine. I mean, the companies I'm working with, when about early start, just about a year ago, when we saw that the market for funding was contracting rapidly, I said to them, look, there's two things you can do. You can try and make your money last, and if you can do that, you're gonna be stronger whenever the market gets better again. Or you can just go as you're doing and hope that someone is going to throw you a lifesaver, and maybe they're not going to be there, and then you'll have to fold your business. And a couple of them really listened, and within weeks they were in profitability. So I talked to them today, and they say, well, if there's an investor, that's fantastic. If there's none, I don't care. I'm making money. So that's I think that at the end of the day, that's basically what you want to have.
What I heard from both of you was, let's get profitable as fast as you can. In theory, it sounds really good, but we'll dissect it because there's two sides to it. Nellie, from your perspective as a CFO, looking, I think we got two great, sort of perspective, but probably from the investment side more so.
Mhm.
But from your side, from the business side, how do you see the market, and what are you seeing?
Yeah, I think that was interesting for me to hear from the investment side. I think from the both private company side and tech side is where I'm speaking from. But I agree. I think my experience has been very similar to that. The emphasis on profitability has increased drastically. For us, this budget cycle, it was an interesting one. It was, I think the magic rule of 40 is something that is important, but it's much harder to attain. And, whereas many companies relied on the 40% coming from top line revenue growth, that's not a given anymore. And so to calibrate that, and probably, not even hit 40% for a little while just in this market, I think top line revenue growth will always earn you more than profitability. But I think if you're burning a lot of cash and EBITDA, that's probably not a sustainable model. And so getting that capital efficient growth and self-funded growth in an uncertain external environment is really important. And so that is 100% what we have been focused on, and what our investors have encouraged us to do.
And to be fair, like Spreedly is much further along in the growth journey. It's also PE funded, so different strategy for cash flow versus
Right.
growth focus. So so there are two sides that there's two sides to lasting longer. One is you get more funds as if you can, and then the other one is you're not getting funds. How do we reduce burn rate and last longer, whatever strategy? So let's talk about both the sides. First one, are there any strategies out there to besides putting AI in your deck, any other strategies to raise funds in this really tight market for companies who are not at that later stage? They need the fund. What are some strategies that they can look at to raise funds now, given what's going on with the inflation and the interest rate and other commodities and assets?
Yeah, maybe it all depends on the business model, right? So there are different ways of getting financing, and not every type of fund will be the right fund for a company, right? There's business models that can generate multiples like what VCs are looking for, and then VC is a good fit. But there's many other businesses who do not have that homegrown type of business model, where you can knock at the door of 100 VCs, they will send you away because your business model is not fit for them. But there's other type of investors. There's corporate VCs who have a more strategic approach. There's even lending, and there's many other ways of finding the right partner. And I think that's the most important thing that a founding team needs to do, is they have to really understand what sort of financial partner is the best fit for their model, right? And it's not about
not anybody who gives you money. You're saying you got to be diligent in who you're taking funds from.
Well, it's not about people giving you the money. The investor has an investment thesis, and your business model has to fit with their thesis. So, and you have as a founder, as a business operative, you also have certain expectations of what a financial partner should be, right? And you need to match these two. If for example, you're the founder of a company and your goal is to actually build something and see it through, even if it's slow, well, then there's going to be a number of investors that will not fit with your model, because maybe those investors want to exit quick, right? For example. So I think that's the strategy has to start with making sure you understand what your business model is and how that fits with the investment thesis of investors.
Yeah, and what you're saying is general good. I mean, that's true for all times.
It's true for every business, yes.
Every business and also all times, not just this titan time.
It's all times, of course. I mean, these cycles exist, right? So we're seeing a difficult time to raise money. We as VCs have difficulty to convince LPs to put money in VCs, and so we have less money to put into companies. But this will change again, and it will, you go back 30 years and you see these cycles coming every few years. Every time there's a little bit of a different flavor to the crisis, but still it's the same effect.
Anything you want to add, Andrew?
Yeah, I mean, Nellie said this before, but the top line growth piece, if you're just thinking about strategy, look, there was a time when also investors would tell you early on in a company, don't worry about getting customers, just build technology. And I never loved that advice in the first place, because how do you know if you're building the right technology if you're not having customers actually pay for it, right? You need the feedback loops to be able to get that. But there really was a time when people would say, do not focus on building customers, focus on building technology. That's the most important thing. I think that's now out the window, essentially, from an advice perspective. I haven't heard another investor give that type of advice anymore, which I think that's good for everyone. This is just it's sort of a reset. So I like that. And from a strategy perspective, again, it might sound crazy that this is actually even a strategy, but getting revenue and getting customers as early as possible is a really good thing to do, even if that means you are limiting the scope of how big of a technology or a big of a platform you're building from the beginning. And it might slow down ultimately it might slow down your development of getting to this massive platform. But who knows if you're even building the right platform in the first place. I think you need customers early on to give you that feedback. So that would be the first thing that I would say is actually focusing on revenue and getting customers as early as humanly possible. Do that, and it will serve you well in your strategy, because top line growth matters, right? To Nellie's point. And then the second thing that I'd tell people, this is probably not as obvious in terms of a piece of advice that I might give. Look, in the past, to software companies, especially, but the technology company, it's a software company. Erwin, to your point, you have to have the right business that actually even, I don't know, qualifies is not the right word, but it's suited for venture investing, which tends to be, you need to have scale that you can build around software, it's technology. And so oftentimes, if you have a services component of that business, venture investors actually might not like that. They might say, hey, we only want to invest in pure technology companies. And so in the past, I've told people hey, be careful about how services oriented your business is at the beginning, because you don't want to kind of paint yourself into a corner or back yourself into a corner. Now, what I would say that's different is I actually tell people, if you have a faster route to being able to get revenue and being able to get customers by doing some services, and you can use the services revenue to actually self-fund in some ways, the growth of your business, and push out when you actually need to get that new injection of a large amount of capital from venture, I think it's an effective way to self-fund rather than literally taking money out of your own pocket and putting it into the business. And by the way, other investors might not agree with this, but like there are many different examples of companies that are massive web scale and technology scale companies that started with heavy services. CrowdStrike is one of them that comes to mind, which is one of the most valuable, publicly traded security companies on the planet. Some people don't know this about their story, but they started doing a bunch of services, and that's literally how they got the feedback loop to figure out what the technology component was that they wanted to build out in order to help these companies achieve their outcomes. At the beginning, they started with just human services to help them achieve their outcomes, and they built automation on top of that to be able to make it scale longer term. So those are probably the two pieces of advice that I would give to people on how do you, sort of attract more funding. Traction really attracts all the funding. How do you get traction? Sometimes you need time, and to buy yourself time, you can do different business models, which would historically not be something that venture investors would love. And services would be one of those things that they could do.
That's a great advice on that. And I completely resonate with that because that's how we started. I mean, we are a services company, and we had offers for funding, but I never saw the point of it. However, we would have scaled much faster, much bigger if we had taken some funding. But again, services is services. And we are actually using services to do a lot of, the revenue from services to fund our course business and all that. And that's another story for another day, things that we need to clean up because, at some point it needs to stop, and that business has to work on its own. But also that gets me thinking a little bit about the fastest way to customer means you are and building the minimum technology needed to get to that first feedback loop means you are very niche, and you are solving a particular thing for a niche set of market versus, how we've seen, when as companies pivot, people build a lot of technology, like you were saying, build a lot of technology and see who comes. You have to be really, you have to really have a very strong hypothesis because you're placing your bet. And if you're wrong in your bet, you are 2 folds or 3 folds the time that it'll take you to get to your right place, but you're at least getting to that fail fast. Is that something you guys, does that resonate in terms of just becoming very focused? Because there's the risk as well. When you're very focused, you might fail very quickly because there wasn't an uptick or take.
I think that resonates with.
Sorry, go ahead.
That definitely resonates with Spreedly's story. Spreedly started as a subscription billing platform, which there were, many of, and discovered that there was a pain point in connections to multiple gateways. And so pivoted into this niche, but learned about that niche through failing fast at something else and having that relationship with, it really started with one key customer who ended up actually buying the billing platform, but, also investing in this new idea. So yeah, that definitely resonates of keeping your mind open, but getting those relationships and having conversations with, people that might need to solve that pain point.
Any other strategies, Nellie, that Spreedly used to get customers faster? I think that might be going way back, but are there other strategies that we can share with our startup clients, startup audience here? Like, I'm right now really needing money, not going to get money. Okay, what are the different strategies I can use to get some money?
Yeah, I think Spreedly's story was more of the conservative, didn't take funding immediately and went, the angel investor route, and grew slowly. I mean, Spreedly's been around actually since 2007, but in its current state with the product that we're selling today, really pivoted in 2012. So it wasn't a short journey to get there. And, I think the beauty of, SaaS is it builds on itself. And so, I think what Andrew was saying, it would be scary for me if I was at a startup and I'm building all this tech and incurring all this expense without customers. There's nothing more validating than somebody buying your product. And so, as that builds and you get your first customer and your second customer, and that's a recurring revenue model that maybe has a services component, I think it was slow and steady, and then it was making contacts with angel investors who maybe had experienced that pain point in the past and believed in it. Spreedly was a niche pain point, but it's a known pain point. You talk to customers who are expanding globally. Now payment orchestration is kind of a trendy term, but really it's like you need multiple connections on your payments stack so you're solving one tiny little payment issue and a huge landscape of what a payment stack looks for. But I think do you have a product that people will buy? Are you solving a pain point that is worth someone paying for?
Fair point. And that's great. So let's shift to the other side, the juicier side, which is burn rate, right? So yeah, we do what we can to raise funds and devise these ways. If we can't get funds, we can, find like services, other aspects of our business, which will get us some cash or get to the cash faster, or get to customers faster. But before we go to burn rate, I had one more questions for you all. In today's market, especially in B2B, the margins aren't there. Everybody's negotiating. So your best customers who like last year said, yeah, this, build this and I will be, they change their contracts, like that it's not there. Is that what you're observing as well? Because that's not how I'm experiencing. We are B2B. I'm experiencing tightening of so what do we do with, you were expecting this much and it's not there. I mean, 40% is a dream right now, but like, that doesn't exist. Is that what you're seeing? Maybe Nellie, back to you. Is that something you're seeing as you're negotiating deals with B2B, all of them B2B? Is everything tightening and the cash is less cash? Even from the customer?
Yes. I think two things. Like, first of all, you have to sell on an ROI concept. So if Spreedly's not saving our customers money, why they're not going to use Spreedly? And so it's the messaging and educating our customers and how we're actually saving them money. And then the other thing is being very creative in pricing and packaging. We rolled out a product of this year of different features that we packaged. We made a few connections that would allow us to have a cheaper cost product, and then we launched it to the market. It's not actually it isn't new functionality necessarily. It's just packaging it and messaging it in a certain way that actually does save our customers money. So that's just the way of the world right now. There's no fluff to spend on nice to haves. And so if your product's saving customers money, it's appealing. If it's not, nice to haves, I know from us, like I just cut all of our nice to have software. So I know that firsthand that's what companies are doing.
Got it. So it goes back to burn rate. Let's talk about burn rate. That's the elephant in the room. How would you encourage our audience to measure burn rate, and what burn rate actually starts giving you an idea of like, we need to rethink, we need to re-strategize, we need to get leaner, we need to change something? How do you look at burn rate? Erwin, you want to go first?
Sure. How do I look at burn rate? So I guess burn rate is a measure of how long you have to live until you need more money, right? So it's very simple. How much cash do you have in your bank? How much are you losing every month? And that's basically, you can calculate how many months of life you have. Now, the thing is, you can't say 3 months or 6 months or 12 months is enough. The question is, what happens at the end of this, or hopefully before the end of this? How are you gonna plug the hole, right? So how are you gonna make sure that you will have enough money to go on? And so the king class is get to profitability, because then you won't have a burn rate. And if you don't have a burn, you're strong. So you can, so you do the bank test. If you go to a bank and ask them for money, normally they will give you money when you don't need money, because you're so sound financially that they will actually want to lend you money, because they know that they're going to get back their interest that they're going to earn. And if you're burning money, people are not so willing to give you money, because they have to calculate the risk of not seeing their money again. So it's not about which burn rate is the right burn rate to have. Is you need to understand how you're going to go after you reach a point where there's no money in the bank, right? Basically.
Theoretically, I can let go of everybody in the company. I'm going to save immediately. But you can't do that. That's a very stupid way to do it. So how would we? Why is that stupid when you look at it from the business perspective? And where is the right balance? How do you look at it and make a good decision versus
So
obviously.
The simplest, might sound stupid, but don't spend the money that you don't have to absolutely spend. Don't spend it, right? If you have a means of not spending the money, don't spend it and keep it for later, right? Now, if you're going to spend the money, you have to look at it as an investment. So if I'm going to spend, I don't know, I'm going to hire 3 people, fine. But do I give them a full salary, or I try to, negotiate with them and give them, for example, some options or whatever, so that the cost to the company is less, right? Or do I give them how you call it, is like a limited contract for a few months and then it stops, or do I give them an unlimited contract, right? Where firing them in a crisis will cost me additional money. Not so important in the US, it's very important in Europe, right? So here you have to be really careful with that.
Andrew, your thoughts?
Yeah, I mean, when you're looking at costs for most of these companies, if you're looking at a tech company, let's say 90% of the costs are going to be people. And I think historically, depending on the size of the company and really just depending on the stage of the company, like cutting people, like it's easy to say from a financial spreadsheet and say, oh, okay, well, if we just cut out these people, then like the costs go down. It's a lot harder to do. It's a lot harder to do in practice, because these are folks that you've worked with that have helped you build your company, that are part of. So I think a bunch of the layoffs that have been happening over the last couple of years in all of tech. Yeah, I think it's lack of discipline that they haven't been happening before. Like these things should be happening, and the way that I don't know, the way that like the sort of colloquial term and in the way that people would talk about it would be like, oh, you're cutting the fat or something like that, right? Like this is actually about creating financial discipline for, and this gets back to Erwin's point, like what is really necessary to drive value in your business that you're creating. And for better or for worse, like not every employee that you have might be necessary for that. And so when I've talked to companies about this, and when I built a company and we had to do some layoffs at different times, there's always fear of what the negative outcome could be from losing people on the team. And that drives most of how people make decisions around human reduction like decisions, right? And I tend to tell people, I was like, look, yeah, there are some potential negative outcomes from this. Not least of which is the actual impact on the individuals that you're letting go, right? Like there absolutely is a cost that is associated with that, both financial and emotional. The flip side is there's some real benefits that you can get by making some of these changes within your organization. Some of that is literally just giving the existing team members some urgency and motivation to step up the work that they're doing. And again, it's not a fun topic to talk about because most people think that there's sort of entitlements around jobs, and there's a sort of an entitlement around the culture of access to jobs that I think people have. But I also tell people when they leave jobs, and maybe they leave because they were asked to leave, it gives them an opportunity to find something better for them too, right? So I think like the natural changes that are happening here around some of the layoffs that are happening with tech, like I'd like to think that this is leading to both healthier companies about the way that they're actually building and running their companies from a financial perspective. And I'm sure Nellie loves to hear sort of advocates for like the health of the company in the first place. But then on the flip side, I think the forced change for people that maybe have been in their jobs for a long period of time can lead to really good outcomes for them also. And so I think that's the thing that we don't really hear much about in the context of these things. But I don't know, I guess getting back to your point is like, why haven't we seen some of these changes in the past? I think it's because it's a really hard thing to fire people. Let's just put it that way. Like it's a hard thing to lay people off. And when that is the driver behind most of the cost of these businesses, it just takes a lot out of companies when they do it. I would just encourage people to do this on a more regular basis instead of waiting until some type of big financial issues that are happening, because I think it actually can create good things for both the employees and the business itself.
That's a fair point. And in another way I look at it is that, let's say you needed 100 people to do X jobs. Maybe you were doing too many things. Maybe if you do fewer things, your bets are only 3, you need only 60 people. And that means it's pretty significant thought process change. You really need to be convinced about your 3 bets versus the 15 you had on the table. And then also it means that you really need to do that planning, pretty significant financial and resource planning, who fits where, to like get from that, which, unfortunately a lot of companies had to do more so recently. But yeah, Nellie, I would love to hear more also from your perspective, from the finance side.
Just one quick thing. Like I would just say like prioritization and urgency, you can do more with less. It's possible to do that. And I've seen many companies actually achieve that. And so like, but you'll never know unless you actually do some of these changes within the organization. So like, I don't know, change is hard, but you don't know until you try it, right? Like what the outcome is going to be. Sorry.
And the flip side is worse though, right? If you did not take that action, the whole ship is going to sink, because you don't have the next round of funding is whatever, 6 months away, you're not profitable, you're still fat, whatever you call it. And then, you're all going to sink together versus, listen, I'm going to put my, tighter bed.
Well, and I'm saying that even profitable companies should be thinking about it in this way, right? Like there is the urgency around, as everyone was talking about this, like, well, this is our burn rate, and like, here's our cash out date. Like that is real urgency for the business, and you have to make some really hard decisions. But when you don't have those, I tend to see that companies get very comfortable with, it's the curse of confidence. Like if they're very confident and the company's doing really well, then you won't make the hard decisions and you kick the can. And like, we had that in my own business, and I would just encourage people to say, like, don't push off hard decisions until you are forced to make those out of financial urgency. Think about building that discipline into your company as just a normal part of business. And yeah, again, unfortunately, that tends to be people decisions that are really hard to make.
And there's another layer to that. So companies evolved, right? So you can start a business with an idea, and you can easily get into a phase where you have a minimum viable product. You can have a few customers. The point is now, what's next, right? So next is you need to start growing, and when you need to start growing, you need to start having to put in structure. And this, on the one hand, it is important to realize, okay, what is the structure that I need to have in place for this to work in a bigger scale? Second, are we qualified to actually put this in place, right? So do we have the experience of setting, processes and so forth? It's you can compare it in the software world. You can make a piece of software that functions, right? But it's not the same that one user is using the software or a million users. So if it's not written to scale, it will not scale. If the company is not structured to scale, what will happen is people will start throwing people at the problems, and when they start throwing people at the problems, their profitability goes down. And there's a point where they realize, oh, now we have a very high or a very big cost structure. What do? We have to fire all these people. And then back to what Andrew says, it's possible to do less with more with less, right? Suddenly you realize, oh, we fired 20% of our workforce and we're still doing the things we were doing. So what were these 20% doing?
Right. Yeah. What came to my mind right now was Twitter, but another story. Nellie, do you want to add something?
Sure. Yeah. I mean, we're talking people focused because generally that is the biggest line item. And we don't often think about that as an investment. But when you're an early stage startup, a people investment, one person is an expensive investment, and you're taking a bet on that. And then I think when you get to scale, the last few years, I know I have relied, because of the employment market, I have relied on natural attrition. And that was, if I had a little extra money in my back pocket, it was because we had turnover and we could save some dollars, time to backfill, that kind of thing. That's kind of gone away in this environment. And so what we've had to do is raise the bar. And that means the people that are, C performers are not worth that investment anymore. And so, we need B plus or A players in order to justify that investment. And so it is important to build that into your culture. And I think, we went through it matched the same time frame when it was growth at all costs. We were throwing money at people to solve problems. That became, a big investment. We probably got lax on moving people out and looking at those resources. So it's almost like you look at your people, just like you need to look at your software and make sure you're getting an ROI on it. And so I think when you're an early stage startup, be conservative on hiring and create standards that, we need A players here, and build it into your culture that we don't hire until we really need it. And if there's someone not performing, it's not worth the investment. We can't carry that investment. I think we, Andrew was right. We should all be doing that, whether we're profitable or not profitable. It's the fiscally responsible thing to do.
There are other big opportunities besides people. I mean, I know people bucket is the biggest bucket. Where there are other opportunities where to cut cost for 50 to 500 people organizations in your experience?
I mean, for a tech company, software is always a big bucket. Office space,
license.
Yeah, lots of, we started doing if you don't use it or lose it on a license of the software, and really manage that side of it. Office space. Do we really need office space anymore? Yeah, looking at and it's a people cost, benefits, and are we too flush on that? I think potentially offshoring R&D, or I think there's a lot of other ways as well. But people in a tech company, typically that's the easiest lever. You get the most bang for your buck, but there are other levers that are important to look at.
Right.
It's ironic, right? So the biggest cost is also the biggest investment, right? So it's your biggest asset, basically, people.
It's the same thing which is on both sides, depending on how we use it, becomes an asset or a liability. So how, Nellie, a little bit double click on for you, how do you use data to do more, to manage all of this in terms of, better bets, or where to cut, or better forecasting, better budgeting? Like, how are you using data as a friend in these times?
Yeah. I think the go-to-market side, that data is really pivotal to understand in terms of leading indicators. I think what we've had to do is use data to really dive into what's working and what's not working, and not assume that it's going to come if it's not in the pipeline today. And so I think, that's all data driven. We did a big, which you'll remember, our trial program, that we kind of suffered through, I think, with your team. And, it was like, we either need to figure out, if this is working, and dive into it and use it as a tool to gain business, or why are we doing it in the first place? And so we've learned that trial is an indicator, in terms of how successful, if they are going to buy or not buy. Just signing up for a trial is one thing, using the trial, how much are they using it? So that data is critical. And, in the budget process, we can't make big bets on the go-to-market side that aren't in the pipeline right now, or we don't see indicators from the external market that they're going to be there. And so you have to calibrate your costs to what you know. And if you're not looking at the data, then you're looking in the rearview mirror, and it's too late.
Indicators and CAC, LTV, predicted CAC, LTV, even to understand, hey, listen, this cohort, how much money is going to net me today, for Q1, and based on that, what my expected is. Makes sense. Anything else you want to add in terms of, there's just so much, I think, wisdom and treasures available internally to us within the organization, from between SDRs and ISRs, what they know of the market, as well as the marketing folks, as well as what, how data can support that story to really make good bets. And a lot of companies think that they don't have enough data, but that's never true. Nobody has perfect data. That's what I say. But everybody has data to make good. But anything else you wanted to add?
So you're right, and we actually just talked about that in the meeting this morning. Like, perfect can be the enemy of good, and all companies do have data. What's usually lacking is either a person or a system to analyze that data and tell you, how do I make business decisions from this data? So, an early stage company, like, get your, systems in place and build processes around, capturing that data, because you'll need that later to make business decisions. And being disciplined in the process, and understanding the kind of data that you want to capture is absolutely critical to the success of a business.
And one thing which is notorious, and you and I, we've worked on it together, was like cost. While from a finance perspective, we know our big buckets of cost, but it's the cost which trickles down to attribution, cost attributed to particular projects to ultimately calculate ROI is what gives you the aha of like, listen, this is our segment, this is our ICP, we are spending a lot of money to it, and get the ROI yet is not as great as this one where there is a differential here. So I think that many companies fail short of really figuring out cost at the minutest level where you need to make a decision of go or no go, which is without ROI you can't quite make that decision. You can't make that decision in the context of revenue.
And I think it sounds stupid. It's very simple, but if you're burning cash and EBITDA, your costs are likely not calibrated with your revenue in some way. So either you're not looking at how much your product costs. Maybe your prices are too low, maybe your costs are too high. But if you're in a burn state, make sure that's intentional and not just from oversight.
Fair enough. Anything else you wanted to add, Irvin and Andrew?
I think this last one was a very good point. I mean, if you have burn rate, you better are convinced that this is good to have, and that this is not just a side effect of bad management, right?
It's deliberate.
Good. So the one thing I would add to this is I think data is good for, or particularly good for using data to make decisions around existing business is good. When you're thinking about areas that you want to invest in that are new business areas, and or maybe your business is new and you don't, you're brand new, you just don't have that much data to be able to rely on, at least first party data, then it can be debilitating is not the right word, but it can just be misleading, I guess is what I would say. Is at some point you have to have a hypothesis that you're building off of. And because I work with really early stage companies, most of what I'm telling them is that like most of business for perpetuity is a hypothesis that you're building off of. And the more data and the more customer points that you get to be able to point to say, hey, these are data points that are validating our hypothesis that we've built a product or a business on. They help to refine the place you're going. It helps to refine maybe even your point of view on that hypothesis in the first place. But it's got to start somewhere where you don't really have data to make that initial decision. And so what I've seen, and I've worked in big companies and I've worked in small companies, but like I've seen it's really easy to apply it to a small company because it's obvious. Like if you're starting out and maybe you have 50 phone calls and that's your data point that you're using. That's certainly not statistically relevant data to make some, data science decision based on that. But it's something, and and that's better than nothing. I would say that that's true for everything, but for really big companies where they do actually have a lot of data that they're pulling off of, I've seen it's really hard for them to make decisions on investing in new parts of a business and making substantial investments in a new area that they don't have already. And that's why I think a lot of those companies then end up having to buy companies and basically spend a good amount of money on acquisitions, because it's the only way that they're able to essentially make pretty big inroads into new business areas, because they're sort of debilitated by the fact that they don't have first party data to be able to justify investments in new areas. There's two sides to all the stories about these things. And I would just say like, there is a place for, call it a gut, call it an instinct, call it whatever, instinct combined with probably third-party data to justify investments in either brand new businesses, and that's certainly the case with most businesses that are getting off the ground, or within new business units of existing companies.
And I would add that though, Andrew, that even when you are venturing into something new, which hasn't existed before, there is a thoughtful, hypothesis-based, external third-party data-driven way of assessing it versus, shot in the dark. And so, even with that new venture, there is a systematic, methodical way of assessing, like, listen, these are 5 bets, and we don't have we are equally, data blind and first-party data blind in all 5. But how can we analyze it relative to each other with third-party data, so we can, have more confidence in that first and second one that we are choosing to do.
Yeah, and that's where that example of, like, we made 50 calls to 50 potential customers, and 30 of them said that they like this feature set, so that's where we're going to start with. Like, I mean, I'm not saying blindly go into this stuff. Like, you want to get that type of data that you have coming back, but that's certainly, again, it's not statistically relevant. It's not like it may not be convincing to a lot of people, but it's something, right? Like, and this is my point, is like, you're always starting with something. And let's say a year from now, instead of those 50 calls, you've made 150. That's better, right? Like, you're going in a better direction than you did when you had 50. It doesn't necessarily mean that your hypothesis is correct, but you have some more data points to say that, like, we're going in a direction that we're getting more feedback on, at least, right? It might not be positive feedback, but
yeah, creating proxies when you don't have exact data that you would, like to have, proxies. So that brings me to sort of like the last topic, but maybe Andrew, I would just say, if you could talk about it. What kind of communication from your portfolio company gives you confidence they're in the right direction, in terms of data they're sharing, validation they're sharing, a quarterly, I'm sure you guys are having quarterly connect. What kind of communication helps you be more confident of your founders?
I mean, something's better than nothing, right? So some folks, they just keep their heads down and they're really focused on that. And especially if these folks are technologists, sometimes their jobs in the past have really just been focused on writing code, and essentially teaching them how to manage up. And not that investors are above people, but, like, they're out of the weeds on this stuff, of just saying, hey, part of your job actually is managing us and communicating with us about what you're doing, right? And at least with tech and early stage companies, sometimes failure actually is how you learn. And so it's okay to say, hey, we tried these things, we got some feedback on it, it didn't go well. But if they're not communicating what they're trying and what's not working, or if they're just trying to communicate the stuff that is working and they don't have a big story about what's working, neither of those paths tend to do a good job, at least communicating for me. Because I tell people, it's like, look, you don't have to sugarcoat this stuff. I want to know what the real story is. I've been in the weeds before, so I can at least help you through that stuff. But something's better than nothing. So I mean, the ultimate is traction, right? So the ultimate is revenue. But a lot of people don't necessarily have that as an early stage thing. So before that, it's more of, hey, what data points are you getting to validate this hypothesis that we all are in together on? And at what point are you going to get enough data that disproves that is going to have you think about moving your business in a different direction, right? And I think at least asking that, for us, being able to ask that question and then have that dialogue with the company, I think is important, because we don't expect everybody to have it perfectly from the beginning. People make changes to the business, that's normal. But if they're trying to hide it and we're not able to help, or we're not able to be a part of it, it's that makes it more challenging.
That's hard. Nellie, anything you wanted to add from your investor reporting that you guys manage?
I mean, I think communication is key, and give what you have and start with the basics. I mean, if you're starting a startup, you need to have a financial software that can produce the 3 income statements. I mean, the 3 financial statements: income statement, balance sheet, and cash flow. That should be a day one thing. And if you get behind there, you're going to struggle to get to the next phase. And listen to your investors on what the data that they want. If it's a good investor, they'll partner with you and show you what they're looking for. And we've been lucky to have good investors who have helped us grow in our journey of data compiling and packaging and presenting. So it's an evolution, but start small, start at the basics. financial statements and understanding those, and communicate with your investors and get their feedback. They're there, or they should be there to support you in that.
That's great. So now is the time for us to wrap. But before we go, I would like each of you to take a second and think about what are your 3 key takeaways you would like an audience who's listening in. What would you like them to take away from this session? What are your 3 top highlights? Erwin, we can start with you.
I always like to keep things simple, right? So cash is king. You should take care of your money and make sure that everything that you spend it on is a good investment. Of course, you will never know up front, but you can have a gut feeling, as we said today, right? Second, I would always make sure I understand what my business model is and who is the best financial partner for my business, so that I can focus my search in terms of, who am I going to talk to and who do I want to attract as an investor, financial partner. And the third point is, what is today will not be tomorrow. So the journey of an entrepreneur, it requires a lot of flexibility. You have to understand in which phase you are today and where you need to go, and make sure that you set up the structures that you will need when you grow. You have to start with things like governance and let's say other things that a startup may not necessarily consider immediately necessary, but it will come, and you will have to have that. And if you have that, if you have the right governance structures, if you have the right processes in your business, you will succeed.
Fair point. Nellie?
So I would say efficient growth wins the day. You still need to grow, but you need to do it in a cost-efficient way. I think being more conservative versus less conservative in a market of uncertainty is the right move for the now. And let's see, listening to, using data to drive your decision making from day one. Don't get so invested in your product or idea that you lose sight on the economics of your business model.
Fair point. Andrew?
Yeah, I mean, I would always say don't let a crisis go to waste ever. So the fact that there's sort of an economic pressure that's happening on a bunch of these companies, like think about the opportunities that you can have in the context of it, right? Like we talked about the layoffs that are happening across the board. Like it's an opportunity to be able to stress test your company to see where you can actually make some of these cuts, and if it impacts the business or the ROI, or if it actually impacts it in a positive way. And don't. So yes, take advantage of the issue of the day, but then the flip side of that is also don't wait until you have those crises to make some of these hard decisions in the context about how you can improve your business. Something that we used to tell our team members all the time is, there's a lot of things that we would try to make consistent and make predictable for the company, but one of the things I said is the only thing that you can predict very consistently is that we're always going to have change, and we're always going to be thinking about how we can change and how we can get better. And so I was trying to guide people to make sure that they were never kind of pushed one way or the other, that they got too comfortable in one way of thinking about our business, because we really needed to always find an edge, and finding an edge for a really competitive market that everybody is in. It really comes down to the more comfortable you and your business can be with change, I think the more set up you are to be able to take advantage of whatever changes might come for you in the future. So yeah, we have sort of a unique time right now in some of the challenges, but to Evan's point, who knows what tomorrow's going to bring and the challenges that tomorrow's going to bring, and having a mentality where you can face those challenges head on and find a way to get through. That's going to create a really important and positive business culture it will ride you through all of the problems that we have coming into the future, right? Not just this one.
Yeah, that's great. Don't let a crisis go to waste. And right now it is for most of our growing companies. And so use it effectively. Well, what a session. A huge thank you to you, Arvin, and Andrew and Nellie for sharing your wisdom with us. And to you, our audience who are listening and tuning in right now, or those who are going to listen in the replay, thank you for tuning in, and keep in touch. Please connect with me and our speakers on LinkedIn and ask us questions and send us your thoughts. Also be on the lookout for our next Data Matters webinar. I think we're going to be talking about agile pivoting next time. So we've got some more great stories and insights lined up for you. Thanks for being here, everyone. Keep thriving, and see you next time.